Okay, so you're running a business with partners. Awesome. But listen, there is one tax form you absolutely positively cannot ignore. Form 1065. Today, we are going to demystify this thing, what it is, why it's so important, and exactly how it all works.
So you're diving into a new venture with your partners. That's fantastic. But before you get lost in the excitement, we need to talk about the absolute bedrock of your financial reporting. Trust me, this isn't just a piece of paper, it's a critical legal requirement, so let's make sure you've got this handled.
All right, let's pull back the curtain and properly introduce the main character of our story today, Form 1065. I want you to think of it as the annual financial biography of your entire partnership. So what is it really? Well, at its core, Form 1065 is what's called an informational return. It's basically the official scorecard your partnership sends to the IRS every single year, laying out all your income, your deductions, your gains, and your losses. I love this analogy. To really get it, picture your business as a super busy sorting office. All year, money's coming in, expenses are going out. It's a whirlwind. Well, Form 1065 is where all of that gets organized, tallied up, and accounted for before anything gets sent out.
Okay, so who exactly needs to fill this thing out? And, why is this annual report so incredibly important? Let's get into it.
This part is actually pretty straightforward. If you're a domestic partnership in the US, you have to file. But here's a detail that trips a lot of people up. If you're a multi-member LLC, the IRS automatically treats you like a partnership for tax purposes. So yeah, if that's you, you're filing a 1065.
Now, this right here is probably the most important thing to get your head around. The partnership itself doesn't actually pay taxes based on this form. Form 1065 is purely for reporting. It's the here's what happened story, not the here's the tax bill we owe form. And that distinction, well, it's everything.
And that brings us to the core concept of how partnerships are taxed. It's something known as the pass-through. This is where we literally follow the money as it flows from the business right into the pockets of the partners.
I mean, this quote says it all, doesn't it? See, unlike a big corporation that pays its own income tax, a partnership just acts as a conduit, a channel. The business itself is tax neutral. All the profits or losses flow through the business, directly to the partners themselves. Let's trace that journey in 3 simple steps. 1. Your business is out there doing its thing, making money and spending money. 2. All of that financial action gets neatly summarized on Form 1065. And 3. The final profit or loss is divided up and passed along to the individual partners, which leads to a very obvious question. How does each partner get their specific piece of the pie?
Well, that's where our second and equally important form comes onto the stage. If Form 1065 is the big report for the whole business, then you can think of the Schedule K-1 as your personal ticket, detailing your specific share of the winnings.
So the Schedule K-1's job is super specific. It takes those big total numbers from the Form 1065 and it tells each partner, hey, here is your exact share of the income, the deductions, and the credits. This is the document you will use to file your own personal income tax return.
So let's just put these side by side so there's zero confusion. Form 1065, that's the big picture for the entire partnership. Schedule K-1, that zooms way in. It's just for the individual partner. One reports the total, the other distributes it. See? They work together, hand in hand.
And let's bring our analogy back for a second. If Form 1065 is that central sorting office that organizes all the mail, the Schedule K-1 is the personal delivery slip that shows up at your door telling you exactly what's inside your package. Simple as that.
Okay, so we get the what and the why. Now let's talk about the how. Getting this process right is absolutely critical, so let's run through a few key do's and don'ts for a nice, smooth filing.
First off, and I really can't stress this enough, your financial records need to be meticulous all year long. Do not wait until the last minute. Next, you have to know your deadlines to avoid some really nasty penalties. And make sure every single partner gets their K-1 on time. Their personal taxes depend on you. And finally, look, when in doubt, just talk to a tax pro. It's not a cost, it's an investment in your peace of mind.
And hey, let me give you a heads up on a major pitfall you want to avoid at all costs. Never, ever confuse the partnership's total income with your personal taxable income. Your income is only the specific share that's reported to you on your Schedule K-1 after all the business deductions. Getting that wrong can cause a world of trouble.
So let's just wrap this whole process up in a nutshell. It's this simple. The partnership reports its financials on Form 1065. It then distributes each partner's share using a Schedule K-1, and that allows each partner to accurately file their personal taxes. Just remember that rhythm. Report, distribute, file.
So we've gone through the mechanics, the how of partnership taxes, but that really just opens the door to a much bigger question, which is about the what. Now that you understand this flow of money, what are the most important conversations you need to be having with your partners about profits, about reinvesting, or just planning for tax season? That right there is where the real strategy begins. Thanks so much for tuning in.